Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Boston Scientific Corporation Annual Report. Boston Scientific Corporation is a leading medical device manufacturer that offers a wide range of innovative solutions for various interventional medical specialties worldwide. The company operates in two main segments: MedSurg and Cardiovascular. In the MedSurg segment, Boston Scientific provides devices to diagnose and treat gastrointestinal conditions such as resolution clips, biliary stent systems, and endoluminal surgery portfolios. They also offer products to treat urological conditions, including ureteral stents, catheters, and penile implants. Additionally, they provide technologies for diagnosing and treating neurological movement disorders and managing chronic pain. In the cardiovascular segment, Boston Scientific offers devices to diagnose and treat coronary artery disease and aortic valve conditions. Their product portfolio includes Watchman FLX, a left atrial appendage closure device, as well as implantable devices that monitor the heart and deliver electricity to treat cardiac abnormalities. They also provide products for diagnosing and treating rate and rhythm disorders of the heart, peripheral arterial and venous diseases, and cancer. Boston Scientific's product offerings include gastrointestinal devices, resolution clips, biliary stent systems, endoluminal surgery portfolios, urological devices, ureteral stents, catheters, penile implants, neurological devices, spinal cord stimulator systems, radiofrequency ablation, indirect decompression systems, cardiovascular devices, Watchman FLX, implantable cardioverter defibrillators, cardiac resynchronization therapy pacemakers, cancer treatment products. Diagnosis and treatment of various forms of cancer. Overall, Boston Scientific Corporation is a comprehensive medical device manufacturer that offers innovative solutions for a wide range of interventional medical specialties. Boston Scientific Corp's stock price has dropped significantly over the past year, with a decline of over 27.8%. The main reasons for this drop can be attributed to two key news events. The first event was Boston Scientific's underwhelming 2026 financial guidance in February 2026. Despite reporting solid fourth-quarter earnings that met expectations, the company's outlook for 2026 fell short of investor and analyst consensus. Specifically, the projected net sales growth for 2026 was lower than expected, causing a valuation adjustment and a sell-off by institutional investors. The second event was the announcement of Boston Scientific's plan to acquire Penumbra in January 2026. Although the acquisition aimed to expand the company's cardiovascular portfolio, investors reacted negatively due to concerns about the deal's size and potential impact on earnings. The stock experienced a decline of 4.6% following the announcement. These two events have had a significant impact on Boston Scientific's stock price, causing it to drop to its 52-week low in February 2026. Boston Scientific Corporation market capitalization of $113 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Boston Scientific Corporation holds a significant advantage in their industry. Boston Scientific Corporation trades at a higher price-to-earnings ratio of 39 times and a higher price-to-book ratio of 4.83 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 44% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The net income of a company underwent significant growth between 2023 and 2025. From 2023 to 2024, it increased by $283 million, representing an 18% rise. This trend continued in the following year, with a substantial jump of $1,045 million, marking a 56.4% increase from 2024 to 2025. The profit margins also experienced fluctuations during this period. The gross profit margin decreased slightly from 69.5% in 2023 to 68.6% in 2024, but then rebounded by 0.4% to reach 69% in 2025. On the other hand, the adjusted profit margin showed a more pronounced increase, rising from 2.51% in 2024 to 3.06% in 2025. The reasons behind these changes are not explicitly stated, but they can be inferred from the data provided. The significant growth in net income suggests that the company may have experienced increased revenue or reduced expenses during this period. The fluctuations in profit margins could be attributed to various factors such as changes in production costs, pricing strategies, or market conditions. The company's financial performance is a testament to its ability to generate positive operating cash flow. The data provided on page 40 of the summary shows a steady increase in cash generated from operating activities over the past 3 years. In 2023, the company reported $2.5 billion in operating cash flow, which rose to $3.4 billion in 2024 and further increased to $4.5 billion in 2025. This upward trend is a clear indication that the company's operations are becoming more efficient and profitable over time. The significant increase in operating cash flow suggests that the company is effectively managing its resources and generating sufficient revenue to cover its expenses. Furthermore, the inclusion of operating lease payments on page 89 adds another layer of transparency to the company's financial performance. The fact that the company is able to generate positive operating cash flow year after year is a significant achievement and a key indicator of its financial health. It suggests that the company has a solid foundation for future growth and is well-positioned to continue generating profits in the years to come. The company's performance varied across different segments and regions. On the positive side, the electrophysiology business unit, cardiovascular segment, urology business unit, and neuromodulation segment all showed significant growth in 2025. The electrophysiology business unit saw notable success, while the cardiovascular segment, particularly interventional cardiology and vascular therapies, ICVT, and Watchman devices, performed well. The urology business unit's acquisition of Axonics and Stone Management franchise drove its growth, as did the neuromodulation segment's Intracept system and spinal cord stimulation and deep brain stimulation franchises. In contrast, some segments and regions struggled in 2025. The endoscopy business unit experienced a decline of -6.6%, while emerging markets saw a -3.4% drop. International operations were also impacted by economic instability, disruptions in global supply chains and labor markets, and regulatory requirements. Furthermore, the company incurred significant expenses due to EU MDR implementation efforts, totaling $464 million through December 31, 2025. Management's outlook for the company is centered around expansion and risk management. The company is actively pursuing strategic acquisitions in key divisions such as neuromodulation and cardiovascular, with the most recent being the acquisition of Penumbra in 2026. This growth strategy is complemented by a cautious approach to managing risks associated with currency exchange rates and interest rates. In addition to expansion, management is also focused on maintaining a strong financial position. The company has demonstrated its ability to repay debt at maturity and actively manages its debt levels. Furthermore, the company is assessing the impact of new accounting standards on its consolidated financial statements, indicating a commitment to transparency and compliance. Management's emphasis on organic net sales growth, ONSG, suggests that they are prioritizing sustainable growth over short-term gains. This focus on long-term performance is reinforced by the use of performance-based RSU awards tied to ONSG metrics. Overall, management strategy appears to be centered around strategic expansion, risk management, and maintaining a strong financial position, with a focus on sustainable growth and long-term success. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends. In 2023, the company paid out $23 million in preferred stock dividends and an additional $28 million in cash dividends to holders of MCPS up until May 2023. In addition to paying dividends, the company has also implemented a share buyback program. A $1 billion stock repurchase program was approved on December 14, 2020, although no shares were actually purchased in 2025 or 2024. Despite this lapse, the company's commitment to returning value to its shareholders remains evident through these initiatives. There are concerns about inventory buildup and supply chain disruption that warrant attention. On the inventory front, while there have been efforts to reduce inventory levels in recent years, with a decrease of $228 million in 2024 and negative $660 million in 2023, some indicators suggest otherwise. For instance, finished goods inventory increased by $51 million from 2024 to 2025, and unrecorded purchase obligations for FY 2026-2030 are a concern. Furthermore, the increasing costs of inventory and related reserves, which rose to $52 million in 2025, highlight the potential risks associated with inventory buildup. On the supply chain front, natural disasters, climate change, and extreme weather events pose significant threats to disrupting supply chains. Additionally, tariff increases on U.S. imports, potential for reciprocal restrictive trade policies, and limited availability of certain raw materials and components also contribute to these concerns. The purchase obligations for FY 2026-2030, totaling $1,051 billion in 2026, further underscore the risks associated with supply chain disruption. The high costs of products sold, including MedSurg, $1,917 million, and cardiovascular, $3,945 million, also indicate potential vulnerabilities in the supply chain. Overall, these concerns highlight the need for proactive measures to mitigate inventory buildup and supply chain disruptions. That concludes the financial summary for Boston Scientific Corporation. Feel free to comment below, and I will be happy to answer them when possible.